So today I'm very excited to have Bill Exeter. William is really his real name. I was looking up for Bill and then I can't find him. But the king of 1031 exchange. Bill has personally helped me with my complicated 1031 exchange transactions. He is a wealth of knowledge when it comes to 1031, but not limited to 1031, also other alternative ways to defer tax gain. Welcome, Will.
Thank you. Good to be on board. How are you today?
Good. Doing good, Bill. It's always great to chat with you. Selfishly, I have tons of questions always have for you. So excuse me if the session goes a little nerdy and deep into how to defer tax. Yeah.
Cool. I'm a fellow nerd, so we're good to go.
Awesome. Great. Awesome. So we're going to start with just the basic of 1031, but we're not going to spend too much time on this session with the 1031, because assuming if you're attracted to this topic, you know what it is. So we want to just make sure a few gotchas there. And also if you're currently in the 1031, Bill has some policy updates in terms of related with CARES Act, with COVID related stuff. And then we're going to spend a lot of time doing the Q&A. I've actually have a preset of questions that I've been kind of minding from different lists of groups. So we're going to get into some very interesting alternatives of 1031 in this session as well. Great. Well, Bill, do you want to take it away?
Sure, absolutely. And I'll kind of bounce around, but we'll cover some of the basics. And then, we call our presentation Unraveling the Mystery of 1031 Exchanges, because you get a lot of people who call and say, I talked to 3 or 4 people, I got 3 or 4 different answers, and I'm so confused, what's the real requirement? And you've probably seen the same thing with a lot of your groups and whatnot, is they get confused as to what are the real requirements versus what are opinions and things like that. So I thought we can kind of cover the more important parts of the 1031, the basics, and then really also why there's so much confusion out there and what creates the confusion and what the real answers are. So with that, in a lot of cases, what you need to do is make sure you have a qualified intermediary involved with the 1031 exchange, and that's the role that we play at Exeter 1031 Exchange Services. And the qualified intermediary really does 3 things. They really draft the documents to structure the 1031 exchange. They hold the cash from between the sale and the ultimate purchase, or if it's a reverse exchange, then they would hold legal title to the property first, and then of course close on the property you're selling later. We'll talk about that real quick too. Let me advance forward here. And so you need the qualified intermediary in advance before any of the closings occur. And that's the key, is if the closing occurs without the 1031 exchange being in place, then unfortunately, whether you have taken the cash or not, you have constructive receipt, and you may actually have actual receipt if they've dispersed the funds to you. And so there's no way to go back and put the 1031 exchange in place. Once you close without a 1031, it's taxable. There's nothing you can do. So you'd have to talk to your tax advisor, see if there's anything else you can do to kind of recover and help offset the taxes from some other part of the tax code. So the critical thing is get the 1031 exchange set up prior to any of the closings, and that's the most important part. And then once that's in place, I think part of our job too is to act as a sounding board. So you can call and brainstorm and throw ideas around and things like that. But the bottom line is, once you get it in place, once the qualified intermediary is there, it's really a tax-deferred strategy. A lot of people refer to it as a tax-free strategy, and it's not really tax-free. It's tax-deferred, and that's really kind of one of the keys there. It's possible to become tax-free, and so the benefit of the 1031 is you're selling real estate, you defer the taxes. But it's more than that. It's really kind of a wealth building strategy. It allows you to keep exchanging over your lifetime. It's what we call, with a morbid sense of humor, it's what we call swap until you drop. Keep exchanging until you pass on, and you exchange throughout your lifetime. And every time you sell a rental property, do an exchange, you defer the taxes, you go into the next property, et cetera. And then when you pass on as the investor, you leave the property to your heirs or whomever, and that gives the property to the heirs. The heirs receive a step up in cost basis, and that means that the capital gain tax goes away, the depreciation recapture tax goes away. And it avoids the Medicare surcharge, that 3.8%, because there's no gain recognized. So it really allows you to continually defer, 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 pass on, and then completely get rid of the capital gain taxes. So most investors try to use, if they're a buy and hold investor, they're trying to use that strategy as hold and swap to a drop and then pass on and leave as much as you can to your kids or grandkids or whomever. And so, and that's the reason they get that the gain goes away, et cetera. It's what they call a step up in cost basis. So let's assume that years ago I bought a property for $100,000 and today it's worth $1 million and I pass on. I would leave it to my daughter. My daughter would inherit that property and her cost basis is stepped up or increased to the fair market value at the date of my death. So since it's worth $1 million today and I pass today, her cost basis is stepped up to $1 million. So she can sell $1 million property with $1 million cost basis and pay zero taxes. And that is huge. That is amazing what it does for your net worth.
You know, I love that you actually covered this specifically for us, because I always heard about the 1031 exchange is, you know, you kick down the can until you kick the bucket, right? So I never understood the part of kicking the bucket part. So are you telling me my daughter, so does she has to pay any taxes, or I'm guessing there's always inherent taxes potentially, but is there any taxes that related with this? By simply the transaction is me dying, right? Like, is there a tax that's associated with that? That's how the cost got now stepped up?
Good question. And that's exactly it. So when you pass, and let's go back to the $1 million property example, if that's your property and you pass away, that $1 million asset is included inside of your estate for estate tax purposes, or people call it inheritance tax or death taxes or whatever you want to call it, but it's an inheritance or an estate tax. Now, most of us, if you're single, you get almost $12 million in exclusions for your estate. As a married couple, it's 23 point some million. I can't remember the exact dollar amount. So it's almost $24 million excluded. So unless your combined estate as a single person is almost 12 million, or as a married couple, it's almost 24 million, you're not going to pay any estate tax. But it is part of that computation. So because they count it as part of the estate tax number, they can't also count it for capital gain tax. It would be double taxation. So it is included in the estate tax, therefore your heirs get the step up in cost basis. Unfortunately, to get that, you have to die. So it's not a great estate plan for you personally, but it does work great for the kids.
For the kids. And actually, you touched upon another thing that's very interesting I just picked up. That's why I love like having chat with Bill, because I just kind of listen to them and then there's just light bubbles like pop up in my head. The other thing you kind of touched on is couple and a single. So as a person who's kind of liberal thinking in terms of marriage and etc., you know, for example, if I'm in a long-term relationship with someone, we have children, etc., and we just by choice, lifestyle choice, not to get married, but there is a benefit to get married to essentially increase that limit to 24 million versus the 12 million. So that may be making some viewers thinking about whether or not to get married or not.
It could, although each person will get that almost $12 million exemption per person. So whether you're married or not, you'll each get that exemption. So I wouldn't rush out to get married just for that. So you'd still get that. There's all sorts of, especially with kids, there's all sorts of estate planning you want to do, like with living trusts, and make sure you take care of the kid, et cetera. And you'll probably each have your own trust. But each of you will get that lifetime exclusion, or that estate planning exclusion of almost 12 million each. Gotcha.
I know we're going a little unconventional, right? So it's our children who has to have that limit. So at the time when we passed away, if they're single, then they're capped to a 12 million. But to Bill's point over here, you know, there's things like a living trust, etc., that also helps with this. In terms of the inheritance taxes.
Right. Yep. And unless the individual taxpayer, so you or me, unless our estate is worth more than that 11 point whatever, almost $12 million number, we won't have to worry about estate taxes. For those who have an estate that does approach or exceed 12 million, then that's where they want to do some special estate planning. There's ways to get that number down. And that's where they really want to talk to an estate planning professional who can look at that and get some recommendations. But you know, the average American never will have an estate that goes over that dollar amount. So it'll always be estate tax free. And then of course you get the step up. So it's also capital gain tax free.
Gotcha. So essentially just kind of put this all together with 1031 exchange is then, you know, if you don't need the money, then you can potentially do 1031, 1031, 1031. And then when you pass away, it will pass to your children. And as long as that whole estate is smaller than 12 million, then, you know, they don't have to worry about paying the tax. Essentially, they will be tax free and they have a step up on the cost basis.
That's right. That's exactly right. Yep.
Perfect.
And that's a good way to phrase it, because, you know, a lot of people think, well, it's an estate tax, so it's my problem. But the problem is when you pass on, it becomes your kid's problem.
Right.
And in a lot of cases, their estate, if it's over 12 million, they probably don't have liquid cash to pay the taxes with. And with that, then the kids go to file, you know, all the forms and the estate tax return, et cetera. And if there's no cash to pay the tax that might be due, then you have a liquidity problem. And it probably forces the kids to sell something in order to pay for the taxes. So that's where the advanced planning comes in. It might be as simple as getting life insurance to provide some cash value at death to pay the bills. It may be something you sit down with the kids and just say, you know, what would you like to inherit? What would you not like to inherit?
Yeah.
And then figure out how to create some liquidity there.
That's awesome. Okay, so tax holding greater than 10 million. Yeah, so along the same way, I think I asked the same question. So Percent asked, when our children inherit it, would they be subject to estate tax and then be taxed for holding greater than 10 million? It would be 12 million %. It sounds like if it's below 12 million, they would not be subject to that. Right?
That's exactly right. Yep. If it's less than, and it's not exactly 12 million, it's adjusted for inflation. So it's 11 point something per person. I can't remember, 11.3, 11.4, something like that.
Okay.
So as long as it doesn't exceed that, then there will be no estate tax. If it does exceed that, then you may have some estate taxes to worry about. But remember too, if you're a married couple or two people, you're going to have that split. So you can split your estate between the two people. So that means you have to really have more than almost about 23 plus $1 million before you're going to be subject to the estate tax. So if you have that much in your estate, that's a great problem to have, but it's a problem. So you have to kind of
so you may
that.
need to like maybe do a living trust, or maybe you need to split two, kind of like a will, like to pass down like a separately, or having the property moved to your spouse's name so that they kind of equal to that 12 before they pass down.
Right, exactly. And there's all sorts of charitable trusts and gifting strategies and all sorts of things that may not be appropriate for most of us, but when you have that kind of a problem, it might be appropriate.
Yeah. Okay, cool. Well, we're gonna back and focus on 1031. That may be a great idea for another session for something else for estate planning. Yeah.
Sure. And there's really three structures, if you will, for 1031 exchanges. By far, the most common is the forward 1031 exchange. In our world, that's about 97% of the volume is forward exchanges. People call them all sorts of things: forward exchanges, delayed exchanges, regular 1031 exchanges, starker exchanges, etc. But that all means the same thing. You're selling your current property today, and you're reinvesting and buying your replacement property sometime in the future within the time frame. So you're selling first, buying second. And that's by far, 97% of the volume that we do is structured as a forward exchange. Those are much simpler, much easier to do. The downside is that you're selling first, and when the sale closes, you've locked in your taxable gain. Then the question is, can you find, identify, and acquire replacement property within all the deadlines? And if you can't, then it becomes a failed exchange. It becomes taxable, and that's a painful experience. So that's the risk. It's the easiest, the cheapest, except for the simplest. But if for some reason you can't find replacement property, identify and acquire it, then it's a failed exchange. You pay the tax. There's no penalty for a failed exchange, except that you're going to pay the taxes you would have normally paid, just like it was a regular sale. The second one, which is 3% of our volume, is the reverse 1031 exchange. And this actually takes a lot of the risk out of the 1031 exchange transaction. And it allows you as an investor to go out and take all the time you want to find the new property, whatever that might be. Do your due diligence, kick the tires, so to speak, and make sure it achieves your goals and objectives. And then you actually buy and close on the purchase first, and then you sell your current property later. So you're buying first and selling later. And with this, you don't have to worry about whether you can go out and find property because you've already found it, you've bought it, you've closed on it. The challenge is it's just more complicated. So with a reverse exchange, I should back up. A pure reverse exchange means the investor could go out, buy the new property, take title to it, and own both at the same time.
Mm-hmm.
The IRS doesn't permit that. So they've set up this parking arrangement where usually the replacement property, the new property you're buying, is acquired and held, or what they call parked, with a qualified intermediary. So we actually acquire and hold legal title to the property. In some cases, there's a method where we can also take title to the current property you're selling instead of the new replacement property. So it really depends on a number of factors. But so the benefit is you don't have to worry about do I or will I find new property. You've found it, you've closed on it. The downside is it's just more complicated. There's more costs involved, but it certainly takes a lot of that risk and worry out of, will I find property or not?
Mm-hmm. Gotcha.
And the improvement exchange, you don't see too many of those. We do a couple every month, but improvement exchanges mean that you're selling a current property. You're going to use the proceeds from that sale to not only buy a new property, but you're going to have excess proceeds left over, and you're going to use those proceeds to improve or construct or retrofit something on the property that you just acquired. So it works very similar to a reverse exchange. We have to take title to the property. Then while we're holding title to it, you make the improvements or the retrofit or whatever you're doing to it. And then at the end of this exchange period, we transfer the property to the investor. And what they're receiving is the original property that we bought for them and all of the improvements we've made throughout that 6-month period. That's why it counts. So the 6 months is really tough on an improvement exchange. If you're adding carports or some minor capital improvements, it's very easy to do. But if you're doing a ground up project, 6 months is probably not feasible. It's not going to happen. So improvement exchanges are really tough.
I did have some question on reverse 1031s on our preempt question list. One of my investor was asking, what other con is there with reverse 1031? I think the obvious one has nothing to do with 1031 is that you need to come up with the cash to buy that secondary property, right? The one that you're exchanging to. So it has, for a lot of investors, that is not feasible. So that will be out of your game. But if you do have cash, or somehow you get hard money lending for a short period of time and you were able to kind of do that, then the first step to purchase your secondary, like your replacement project, is probably contact someone like Bill to make sure that it's the right structure that's holding the entity that you're buying, right? And before, you're selling the other entity. So I think, and then that's what a 1031 exchange facilitator kind of helps you do. So before you even sign a contract, this is something that you should probably, before you even want to sell anything, that's maybe something that you want to get talk
Absolutely,
to Bill.
yeah. And you hit the nail right on the head, which is the lenders.
Mm-hmm.
Traditional lenders are going to typically make the loan, sell it to investors, so they're not going to touch a reverse exchange. Mm-hmm. It's going to be, those are what we call conduit lenders. They fund the loan and sell it off to Wall Street.
Yeah.
So you're really going to look for a portfolio lender. And a lot of times it might be a small community bank or small regional bank, and they're willing to make the loan and keep it in their portfolio. And then they're more flexible with their terms. Or you mentioned hard money, private money, et cetera. Those folks typically would do this all day long, although it's just more expensive.
That's actually a great point, Bill. Because we actually went through this particular transaction with a normal 1031 exchange, but then we were talking about, hey, we may be short of this amount of money. Then I was like, hey, I want to sell the other property. Could not do that with a reverse, one forward. And then so the loan that we try to do, as you know, I always have a lot of complicated situations, as we kind of go through this, and our lender basically is a Freddie Mac loan, which is an agency loan, and they're like, actually, we checked out where it's legal. This is impossible to do on the reverse 1031. So forget about it. So I'm really glad that you brought that point up. Yeah.
Yeah, in fact, a lot of cases when you're doing reverse exchanges, if there's going to be financing involved, that's the first question and the first thing we want to look into. You really want to do a conference call with the lender, see if they can actually do what they say they can do. And in a lot of cases, the initial contact at the lender or the mortgage broker will say, oh, sure, we do 1031s all the time. They don't realize that a reverse 1031 is very different. And
Right.
they'll tell you yes, and then later on you find out couple days before closing, no, they're not going to let you do that. You're like, what?
Right. And the legal
So
counsel don't really get engaged in our case with agency loan until like a pretty much, they're there, but like once they go through all the documents, they will tell you what is not feasible.
yeah, and it's always the last minute. So you'll want
Yes.
to address that up front. And your other comment's right on the money. If you have an all cash transaction, makes reverses that, they're still complicated, but it makes it a lot easier to structure without the lender. But that's a lot of cash to come up with.
Yeah. One more question that we had on reverse 1031 was like, how much does the cost roughly? I mean, you can give us kind of rough cost range. Every situation is different, obviously. And then maybe more helpful on like a portion of expenses in comparison with a regular 1031 exchange that you would.
Sure. And I can kind of give you the range that I see out in the industry, and I'll give you our fees as well, so you kind of can compare and contrast. So with a regular forward exchange, they tend to be cheaper on the West Coast and get more expensive on the East Coast. There's less competition on the East Coast. On the East Coast, you get more attorneys who are actually doing the exchange, so they charge more, et cetera. So if you, like with us, with an institutional qualified intermediary, normally the fee is going to be $750, $850, $950, something like that. You get a few that are between $1,000 and $1,200. And part of that you have to keep in mind is historically the fee is only 25% of the fees, and then we earn money on the float, and that's where you make the big part of your, about 75 to 80% of your revenue. Well, interest rates are very low today, so that hurts the qualified intermediary. So you're going to start to see some of the fees in the $1,000 to $1,200 range because the interest rates are so low. But that kind of gives you an idea. So, and the closer you get to the East Coast, you'll start to see fees going up to the $2,000, $2,500 range, especially if it's an attorney or CPA. When you get into reverse exchanges, there's a number of moving parts there. There's the complexity, there's excess documents, there's the risk to us, et cetera. So the fees are higher. And the component parts are this: you've got the standard 1031 exchange, and the documents are similar, but a little different for the reverse. Then you have a whole set of documents that cover the parking arrangement, where we hold legal title to the property. So that's the legal title or parking arrangement, as we call it. If the qualified intermediary is doing a good job, they're going to set up a brand new separate LLC just for your transaction. They're never going to reuse that entity ever. Now that's more expensive. It increases the cost, but that's the right way to do it. The last thing you want to do is use the same entity over and over and over for all of the clients, because at some point there's going to be a client that has a lien or a judgment or something, a litigation, whatever it might be, and it's going to attach to the entity, and it may attach to all the properties that go through the entity and will affect other clients. So there are unfortunately qualified intermediaries who take that shortcut and use the same entity for everything. And they do it to keep, well, it's easier for them to do it that way. And it keeps the cost down for the client, but it just takes that one situation that becomes a nightmare. So a good QI will not do that at all. They just won't offer it as an option. So with that, all of that should be packaged together and included in the same fee. So our fee for a reverse as a base to start with is $6,850. And that includes everything I just mentioned. It also includes all the costs to set up, maintain, dissolve the LLC, all the consulting, and anything else down the road that pops up. There's always residual stuff that happens. Because we're on the chain of title, and we probably are the mailing address that shows up on some of the policies and records and what have you. So that includes everything that happens after the fact. I've seen reverse exchange fees are all over the place. For the good qualified intermediaries that really know what they're doing, I've seen them anywhere from like $5,500 to maybe $10,000, $11,000-ish. And I've seen some that are ridiculously high in the $20,000, $25,000, $30,000 range. That's just nuts. The only time that makes sense is if it's a transaction has significant risk to the exchange company. That's really the biggest part of the issue is risk, because we're holding legal title to the property. And if something goes wrong, we're on title, we get sued. So that's really the biggest part of the fee, is to compensate for the risk. You're going to see smaller exchange companies who don't understand the risk, don't really understand what could go wrong. And that's the only way they can get business, is they'll charge $3,000, $4,000, $5,000. Be very careful. Reverse exchanges, when we're holding title to the property, they're supposed to be reported on the corporate tax return as property held by us for the client, really held as property held for sale. And a lot of those who charge, $2,000 or $3,000, they're not reporting it on their tax return like they're supposed to. It just, they have to cut costs, cut corners. So be very careful on fees.
Sure. Yeah, because I mean, it goes with the same rules, right? Like you want to make sure you have qualified. Again, has to do with legal. This has to do with liability. So it's the same, argument. I think I always say is like, hey, do you want to just like open your own Wyoming LLC by just going to the website, doing it for free? Or do you actually want to make sure that it's actually protecting you by going through a lawyers and setting up the right company agreement and bank accounts and all the other stuff along with it? Because a free transaction or a low fee transaction over there gets you more liability issue. That's not really a good trade-off. Yeah,
that's very true. Absolutely.
Yeah.
It boils down to the old adage: you get what you pay for.
Yes. Cool. Okay, and then we have more questions later. That's actually a very asked question about cost segregation and how that intermingles with 1031. But I'll let you go on with the presentation.
Sure. And before, I wanted to back up real quick to reverses again. Oops, went too far. What you said triggered a thought too. So reverse exchanges, of course, is one way to do it, but there's other ways to kind of pull it all together that might be feasible and might be less costly. So for example, if I was doing a 1031 exchange, I knew that I was going to ultimately sell my current property and I wanted to 1031 exchange it, I'd start looking for replacement property right away. And if you find the property you like, before you go down the reverse exchange path, you can always try to see if you can lock it up. Maybe you can lease with an option to buy, or just do an option to buy. That might work. You may be able to go under contract and have a little higher earnest money deposit and have a long-term closing date. You might be able to work in a number of 30-day options to extend the closing. So if you can lock up the property but not close on it and control when you can close, then you could probably do a regular forward exchange. But some sellers just won't cooperate.
Yeah, and that's a situation that we did. And I'm imagine you have somewhere in your your 1031 deck over here to talk about some of the tenant in common stuff. We did a tenant in common, which is essentially, I'll have Bill explain it, but it's essentially a forward 1031. And we worked with on both ends. On our selling part, like when we're selling to our buyer, we had a prolonged contract that negotiated so that they will allow us to have 2 extension period of 45 days per. So which essentially gave us a very long closing window. I think it was 30-day per. So that gives us extended out like 120 days to close, which is a tremendous amount of time. And on the other side, when we're purchasing a property, that property had someone essentially wanted to sell 1031. So there was incentives to wait over there too, or flexibility to wait as well. So on both sides, it take a while to do these transactions. It could be a half a year to finish the whole thing, but it gives a tremendous amount of time for us to execute that. Yeah.
Yeah, and those are perfect ways of reaching out and trying to get these in place. And if it doesn't work, then that's the reverse exchange is really a fallback position. But it's a great way to kind of bail you out if you can't get.
And Bill, you said this to me that was really cool, because I think we can spend our brain power to kind of think about like what are other ways to defer tax, but sometimes the best solution is actually paying taxes, especially during this year, COVID-19. Unfortunately, for some businesses, they're suffering, and so for some investors, so they're actually could potentially have losses in the stock exchange or the other thing that lowers their tax bracket. And then so maybe it's a kind of year, and then that you didn't want to pass it to your children, and this may be a good year to kind of exit these projects. Just another thought over that, and then paying the tax at a lower rate. Yeah.
It's amazing how many times we see clients who do an exchange and they're going to defer the taxes, period. And then they end up buying a property that's really a problematic property and they end up regretting it. So that's exactly right. You know, sometimes if you can't find the property that meets your goals and objectives and doesn't pass your due diligence requirements, that's when you just say, you know what, I tried, I couldn't find anything that works, I'm just going to pay the tax. Otherwise, it's the old adage, you know, you go to bed with a dog with fleas, you wake up with fleas. And that's what happens sometimes. So you just have to make sure you don't get emotional that you're not going to pay the taxes, period. It's, you know, this is a strategy that should put you in a better position, but if you're not going to end up in a better position, that's where you say, okay, enough, I'm going to throw in the towel and this time I pay the tax.
Mm-hmm. Cool.
I'm going back real quick to the qualified intermediary. We get a lot of questions, especially recently with the COVID-19, where people are asking, you know, how do I choose a qualified intermediary? What should I look out for? And the first one is government oversight. People are always shocked when I say this, but less than 1% of qualified intermediaries out there have any kind of government oversight or regulatory requirement. So 99% plus have set up shop as a qualified intermediary and have been, you know, doing exchange business, some for a very short time, some for a long period of time, but there's no government oversight. And I've seen a lot of failures over the 36 years I've been doing exchanges, and most of them could have been avoided had there been government oversight, and the things they have done would have been caught during annual audits. So I think the most important thing is make sure you get a qualified intermediary that has government oversight, so you know somebody's watching them to make sure they're operating in a safe and sound manner. Second is, we're all human, we're all going to make mistakes. So you want to make sure there's bonding and insurance. And a lot of people focus on the fidelity bond, and that's important, but we do a lot of expert witness work. And most of the losses we see that happen are the result of an error. Somebody either made an error or omitted something, and that created a loss in the 1031 exchange. So errors and omissions insurance is more important in my opinion. And that's one that a lot of QIs don't have. Nobody asks about it, so they just don't buy it. But fidelity bond, errors and omissions is the most important. Fidelity bond is number two. Fidelity bond is crime insurance. So theft, misappropriation, embezzlement of funds would be covered under a fidelity bond. So you want to make sure those are both in existence. We also have a financial institutions bond because we're licensed, regulated, and audited by the Wyoming Division of Banking. We're actually a trust company. So we qualify for the financial institutions bond. That's a deeper, broader coverage, et cetera, because we're a financial institution. And then finally, make sure your funds are always held in a separate, segregated, dual signature qualified trust account. We could talk for an hour on why. So I'll leave it at that. Just make sure it's, number one, you want it separate and segregated. Number two, you want dual signature. So what that means is your funds are held in an account, a trust account, all by itself. Number two, that means it requires signatures of the qualified intermediary to authorize a disbursement, but it also requires the investor's signature to authorize a disbursement. So that's critical.
But you're going to be able to take care of all that, right, Bill? Like if you're doing facilitation, like you should be expecting your facilitator doing all this.
Yes. In fact, we identified that years ago and realized if we're going to do it right, that's what you got to do. So we went through a number of years of the regulatory approval process, and we got licensed by the Wyoming Division of Banking. So we actually chose Wyoming for many reasons, put our trust company in Cheyenne, Wyoming. So all the funds are held by Exeter Trust Company, and they're audited once a year by the government, et cetera. So that's critical. This next topic is probably the most important one in the slide deck. It's what really is the heart of a 1031 exchange. It's also one of the areas that has the most misinformation out there. So I kind of wanted to spend a little more time on this and kind of go a little deeper here. So, a lot of people are talking about a 1031 exchange and they start asking the question, well, how long should I hold title to property? And the advisors will say, it's got to be at least a year and a day, 18 months, 24 months. And that's where they call us and say, I'm so confused. I'm getting all these holding periods. I don't know what to do. The issue is that there is no holding period. The tax code, the regulations, the rulings have absolutely no holding period required. What it does have is the requirement that you have the intent to hold for rental, investment, or business use. So intent is critical. That's what it boils down to. And if the investor gets audited, they have to show they had the intent to hold for rental, investment, or business use. So clearly, the longer you hold title to property as rental or investment or business use property, the easier it is to show intent. That's why advisors often recommend a year, year and a day, 24 months, what have you. But that's the only thing it does, is that it helps prove intent. It does not mean it either does or does not qualify. So it all boils down to, what are you doing with the property? So let me use some examples. First, if you are in the business of buying property and rehabbing it and then selling, so you're either a rehabber, flipper, whatever you want to call it, you're really buying and holding with the intent to sell. You're not buying and holding with the intent to hold for investment purposes. It's really treated as inventory in your real estate business. You're buying, rehabbing, and selling. So it's inventory, and you're just churning it as fast as you can. That's the goal. If you're a developer, contractor, builder, same thing. You buy, you build, you sell. You're holding for sale. You're not holding for investment purposes. If you're a condo conversion specialist, same thing. You buy, you convert, you sell. So all of those are really intending to hold for sale. It's inventory. They're not intending to hold for rental, investment, or business use. So those won't qualify for 1031 exchange treatment. Now, if any of those folks were to buy and then either rehab or build or convert and then hold, and actually hold them as rentals, then they would qualify for 1031 exchange treatment. So it really depends on what's your intent and what can you prove under an audit. So that's why you get all these holding periods, but it's really, what can you prove? So let me give you a couple of examples. There's two tax court cases, totally unrelated. Both are developers, both bought dirt, both intended to build single family homes and then sell. Neither one in these cases built anything. They just held the dirt. One held the dirt for 12 years, one held the dirt for 20 years. Both ended up selling, and both did 1031 exchanges, and both got audited, and both were disqualified. And everybody was shocked because the holding period is 12 years and 20 years. And they thought, oh my God, that's a long-term holding period. How can that not qualify? The problem is, it's not the holding period. It's the fact their intent was to buy, build, and sell, and they never did it, but that was the intent. Now, somewhere in the middle there, had they notified everybody, my business plan has changed, the market has changed, what have you, and I'm going to hold these now for investment purposes. I'm not going to build. And if they had changed the way they reported it on their tax return, their financial statements, their loan applications, and correspondence, their exchanges would have qualified, because intent can change, but you have to be able to document it. On the flip, oh, go ahead.
Just kind of put into the perspective of apartment syndication. This is me selfishly asking a question for myself. With apartment syndications, we always talk about exit, and it's a smart investment to always talk about the exit anyways. Period. Doesn't matter what you're invested in. So that's okay, right? Because the part of the apartment business is that cash flow elements in terms of holding period from the rents. So that kind of qualifies the intent to hold, even though our end goal for syndication is always picture a syndicate, like essentially an exit, whether 5 years or 10 years or 7 years or whatever it is.
Absolutely, because your intent really is to buy and hold as apartments or rentals. Everyone has an exit. Well, I shouldn't say that. Everyone should have an exit strategy. Most don't, but there's always an exit strategy. Everybody's going to sell eventually. So obviously we're all holding for sale at some point. It really boils down to what's the intent. So in that example, your intent is to buy and hold as apartment rentals. And then later on you will sell when it makes sense. But the intent is to really hold for rental. Where if it's a true developer, they're going to buy, build, and sell it. They have no intent to rent. They never rent. So it really boils down to the intent. On the flip side, we had one of our clients sell to an exchange by a condo. So it's a smaller transaction. Unfortunately, did not read the CC&Rs until after the close of the sale, the purchase. And once it was just like a week and a half afterward, he read the CC&Rs and found out he was not permitted to rent them out. It had to be owner occupied. So he, first he panicked, sent a lot of emails around and what have you. But he eventually quickly sold, did another exchange, and bought a property he could rent out. He held title for, it was like a month and a half or so. He was audited by the California Franchise Tax Board, and they actually allowed his 1031 exchange because he could prove his intent was to hold. But there's a business reason why he couldn't. And so he had to reposition his portfolio so he could rent. So it just shows that it's, you know, the intent can change, and you just have to document your intent. That's what it's all about.
That's awesome. Cool.
And the next, so we kind of covered the holding period. Just keep in mind that the holding period is not the end all. The holding period is just part of the equation. It helps you document your intent, and it helps prove your intent. But a short-term or a long-term holding period doesn't necessarily mean you will or won't qualify. It's all about the fact pattern and whatnot. The next topic is like-kind property, and there's lots of misinformation on this one also. So I'll break this down to you so it's really easy. Like-kind means you're selling real estate. You're selling something that's classified as real estate. So you have to acquire something that's real estate. That's all it means. Real estate for real estate. And there's still a lot of people, there's a lot of curriculum and classes, there's websites that'll say if you sell a condo, you have to buy a condo. If you sell apartments, you have to buy apartments. And that is absolutely not true. It means if you're selling real estate, you have to buy real estate. Simple as that. The only area where it gets a little more complicated is if you're investing in foreign property in foreign countries. You can still 1031 exchange foreign property, but you have to exchange foreign property for other foreign property. You can't sell U.S. property and buy foreign property. You can't buy foreign or sell foreign property and buy U.S. property. They either have to all be United States based, or they have to be all non-domestic or foreign property based. You can't go back and forth. And personal property means non-real estate. You used to be able to exchange personal property. So we used to do a lot of exchanges of like aircraft for aircraft, 18-wheel trucks for 18-wheel trucks, machinery equipment, farm equipment, livestock, etc. We've done some really bizarre exchanges over the years. And the Tax Reform Act changed that. So now the only thing that qualifies is real estate, but it does have to be real estate for real estate. So a lot of folks get confused on it. Just remember that it's not condo for condo. And this list will give you an idea of what's considered. All of these are considered like kind to each other. It includes water rights, air rights, mineral rights, oil and gas interests, vacant land, farmland, ranch land, timberland. And there's a lot of things that qualify or are defined as real estate. And as long as you're selling and buying real estate, like kind has been satisfied. So really the important issue to worry about is the qualified use, which we just finished talking about. And you had mentioned tenant in common interest. So fractional ownership absolutely qualifies. So you could buy a 10% undivided interest as a tenant in common in a property, and that's considered real estate. Or today, a lot of them are being structured as a Delaware statutory trust, a DST. That would also qualify. You buy a 10% interest in a trust, the Delaware statutory trust. That's considered a purchase or a sale of real estate for tax purposes.
I do have some questions around here.
Sure.
It's non-like kind of properties. So back to like kind of property, I think here's where you actually can go really creative. Was like, because people are like, oh crap, like my 1031 exchange didn't fall through, so I now faced with tax consequences. Or could I actually identify something to kind of park my money? Like one is obviously you can find a property that's almost the same, like slightly higher than your sell price, and then you just defer all that proceed there. It is not necessarily maybe it's a better investment because it's in a better location or whatever, but it's got a very low LTV. So you just kind of like park it over there. That gives you a little bit more time to kind of do another exchange or something later, right? But
yep.
Yeah, so that's maybe just the very straightforward one. But then you mentioned about Delaware Trust, that was actually a question I collected. Obviously, I think you can name who asked that question because that person probably asked you many questions like that. So one of the questions that he had was, can you 1031 a performing note for a non-performing tape? Can I 1031 the riparian rights of my land for an apartment building? Or can I 1031 exchange tax credit? So what are some like kind of things that I can potentially exchange?
Good credit. What was the first asset he mentioned or asked about?
I think you know who I'm talking about. Can you 1031 exchange a performing note for a non-performing tape? I don't know what tape is.
Good question. So So let me kind of dive deeper on that one. So the initial answer is usually no. A promissory note of any kind is not considered real estate. So whether it's a performing note or a non-performing note, it's a promissory note to pay, and that's all it is at that point. It's probably secured by real estate. So it's either secured by a deed of trust or a mortgage. But at that point in time, it's just a promissory note. So it doesn't qualify as real estate. However, let's assume that you're selling real estate, you're doing a 1031 exchange, and then you find, let's say, a non-performing note at a local bank or financial institution. And it's, I guess let me describe it first and we'll go into the issues. So that you find this non-performing note and the bank says, you know, I'd be willing to sell this to you at a discount if you're willing to buy it quickly. I need to get it off my books. And you're interested. But what we could do is kind of like an improvement or build to suit 1031 exchange. So we set it up so that we go out and we buy the note from the bank. We as the qualified intermediary, we hold the note, and then we have to convert that note to real estate. So it might be that we negotiate with the, I mean, you would be negotiating, but it'd be under our name. So you might negotiate with the borrower and say, can we do a deed in lieu of foreclosure? Maybe we do a short sale or fire sale. Maybe we have to go through the foreclosure process. In a lot of cases, the lenders probably already started the foreclosure process. So in that case, you want to buy the note as close to the trustee's sale as possible. And the whole idea is hopefully we buy the note, you go to the trustee's sale, you win the bid, it becomes real estate, you get a really good discount. But now Exeter 1031 is holding title to real estate on your behalf, and then we transfer it to you. So Exeter buys the promissory note, which is personal property, then we convert it to real estate and pass real estate on to you. So that was a lengthy answer there, but so the initial answer is usually no, but there are possible ways of doing it in a creative way. What was the second asset again?
The second question he has, can I 1031 the riparian rights of my land? Riparian as a RIPARIAN, rights of my land?
So I think they're referring to the riparian water rights effectively.
What is that? So, water rights. Okay.
It's usually water rights. And so in that case, yes, if they are truly water rights, and they usually run with the property, which means if you buy or sell the rights, you're usually doing it through a deed. That can certainly be done. It's very similar to water rights, air rights, mineral rights. Most of those are done through a deed, and in most states, they're considered to be real estate. And that's the key, is you want to make sure they're considered real estate in the state they're located in. But yes, you could, if they are considered real estate in the state that they're located in, you could sell that and exchange into regular, apartment complex or what have you.
Yeah, that's what he wants to. Okay. And then vice versa works too, right? So any of these assets we're talking about, vice versa. And
absolutely.
Then the third question was, can I 1031 exchange tax credits? Can you be more specific on the tax credit? That's very interesting.
Yeah, the tax credit is probably a no, because that's actually not considered real estate at that point. You're getting a credit against your taxes, but it's not a real property ownership position or interest. Okay. So there's no way to really 1031 exchange that.
Gotcha. I was like, ooh, that would be really good. Yeah. Is it better to refinance first than 1031?
Good question. So it all boils down to your intent. And what we don't want the IRS or the state to think is you didn't have the intent to reinvest the equity or the proceeds. So if you're to refinance and then immediately sell and do a 1031 exchange, under audit, they could say you didn't intend to reinvest that amount of money. You pulled it out through a refinance, therefore it's taxable. So it's generally considered safer if you do it after you complete your 1031 exchange. So here's the rule of thumb I kind of follow. If you need to refinance prior to doing the sale and 1031 exchange, I would refinance and wait at least 6 months. We want enough time in between there to show that the refinance cash out was not linked to the sale. Or if you could possibly wait, which is the better way to go, don't refinance in advance, finish the 1031 exchange, then just wait 2 to 3 months and do a cash out refinance. There are some people that will tell you you can refinance the day after. There's enough tax attorneys that are worried about that I wouldn't do that unless you absolutely were desperate. I would wait 2 to 3 months, so there's enough seasoning there that it was not linked together. I wouldn't do it the day after.
So that's actually a very rare question because we're kind of thinking about doing some of that. Most of the lead up cost to that is mostly because we put a property on sale, and due to the COVID, we realized it's probably not going to be a quick sale. So then we were thinking about maybe we can just cash out refi. We don't really have a definite time. If the right buyer comes along, we will sell it. But for now, is there some documents that we can potentially write to make sure that we're covered there? Like, for example, email exchange between partners. Hey, maybe we intend to hold, whatever, that to kind of increase the possibility of withstand audit.
Absolutely. In fact, you hit the nail on the head is emails. Emails can be used to defend. It can also be used to prosecute. So you have to be careful. But emails are the perfect way to go because it's a great way to document that. And so emails between you and your partners would be a great way to show, what you've been discussing and what your plans are. Emails to your lender too could be that, our intent is to do this. However, because of COVID-19, we've decided now we're going to cash out refinance, and then some point down the road when it makes sense and things have gone back to normal or what have you, then we'll look at selling. Keep in mind, a short-term issue is not necessarily a problem as long as you can prove what your intent was. And COVID-19 is one of those things that is outside of our control. So, we can certainly say this was our intent. However, COVID happened, and now we've got to kind of change directions a little bit. As long as you can document that and explain it, then you're in good shape.
Yeah, that's exactly kind of what's going on. Great, awesome. And we have a question on also partial exchange. So let's say, I couldn't find a property that's higher priced than what I bought it for. What I sold my property for. But I found something, just give a real example. You have $1 million sales price for illustration with debt, let's say $600K. Let's say the proceed after sale is $300K if we purchase a new property for $500. Sorry, I'm just kind of reading this question over here. Sure. So let me give maybe a better example to kind of illustrate this. I know one of the rule to exchange is that when you sold a property, the property that you have to purchase has to be higher than what your selling price is. And this is kind of a reminder, if you do a tenant in common, you need to do that calculation, make sure that the partial share that you got, the essentially the end entity that you're part of, that's going to be, your portion is going to be bigger than what you exchange out, because we cut pretty close over there when we did that. And then so that's one rule. So I think he's asking, hey, in the case when the property I found is maybe lower price than what I sell it for, and I can find a secondary one to do 1-to-2 exchange, essentially, because you can do that. So what portion am I responsible for paying tax on? How does partial kind of exchange work?
Good question. And I like the question because there's a lot of misinformation out there on the internet as well. There's a lot of websites that will say you absolutely cannot trade down in value. Well, what they're really saying is you can't trade down because you'll get hit with taxes. Doesn't mean you can't trade down. So partial exchanges are absolutely okay. It does not hurt the 1031 exchange, except you'll be paying taxes. So if you sell for $1 million and you reinvest at 800,000, you've traded down by 200, that 200 will be taxable. And it's not prorated in terms of your cost basis or anything like that. So the full 200,000 would be taxable.
Okay.
Or you sell for $1 million and you buy for $1 million, but you get a larger mortgage. So you end up with cash out. That's considered not reinvested, so that would be taxable. So even if you sell for $1 million and buy for $1 million, but you get a larger loan, which results in excess cash, that's considered cash boot. You pay tax on that too. So again, it doesn't hurt the exchange. It just means you're going to pay some tax, and people do it on purpose all the time. It's the old adage: people are usually real estate rich and cash poor. So sometimes pulling a little cash off the table and paying some tax is not a bad thing. It just depends on what's right for you.
Yeah. And this kind of just remind me of another note that you have told me about. It's along this way. It's, again, tax planning. And I'm not a tax professionalist, even though I look into tax topics all the time. One thing that you mentioned to me, I had a question for you is like, hey, when I have a partner in the LLC with me, two of us are kind of tight together because the LLC is the entity that holds the property. So what's a better way for me to kind of give him, eventually get me cash out, but without accumulating a large sum of capital gain, essentially when we part our ways? Because unlike children, your children and you, or your spouse and you're not going to be tied in the hip maybe for 10, 20 years, but not like forever, right? And there's no inheritance to help you out over there. So you mentioned to me like, hey, maybe you want to sell your share to this guy like over the time, like when you have a low tax year, which through apartment syndication I get a lot of negative tax credit, and you don't pay tax anyways. You use that to offset that, and then so over the time he will buy you out slowly, and then at some point you can't just buy you out completely. At some point, maybe just swap the member, having his children being part of that. So I thought that was brilliant, and I want to kind of share with our audience. This could be a tax strategy that you have, and just kind of extend my thought a little bit. And over time, he could also increase the portion that his children owns slowly and paying the tax on a lean tax year for his portion. So essentially, there's a good way to kind of transfer into his children, without having to go through inheritance task. And just kind of
Absolutely. And remember too that for the listeners out there, each of you has the ability to gift $15,000 per year per person. So it's a lot of paperwork, but literally every year you could value the property and then gift $15,000 worth of membership interest in the LLC to your kids. And then over time, the same thing, over time, your kids are receiving a larger percentage of that LLC. And as long as it doesn't exceed $15,000 per year per person, there's no gift tax issues to worry about.
Mm-hmm. Gotcha.
I think the one thing investors often forget is when they have a LLC with multiple members, or a partnership or limited partnership or a corporation, is they don't individually own real estate. They own an interest in the entity. And when the entity sells the real estate, the individuals can't do an individual 1031 exchange because they don't own real estate. They own a partnership interest or a stock interest or what have you. So that's the issue that we have to address up front. And that's why I kind of laughed before. Nobody really has an exit strategy, but you really should. I mean, sit down with your advisors and say, okay, what do you think your exit strategy is? What do you, it may change, but what's the most likely outcome? And then look at the way you hold title to real estate and ask the question, is that going to cause problems? So for example, probably the most complicated issues we get day in and day out are LLCs with multiple members. So it's treated as a partnership for tax purposes.
Mm-hmm.
And then they're going to sell the property, but they're all going to go different directions. The LLC
Right.
is not going to stay together. And so there's all sorts of ways of addressing that. But that's one of the issues. Keep in mind that the individuals don't own real estate.
Gotcha. Cool. And then so, sorry, like wanted you to kind of wrap this up, but we do have a lot of other questions that we have pre-collected. So we can kind of go either way, but as you listed over here, not like kind of property, you want to kind of go through this slide with us?
Sure, absolutely. So there's really kind of two sides of non-like kind. So anything used as a primary residence, second home, vacation homes generally don't qualify as like kind because it's personal use. Intent can change, and there's all sorts of ways to plan for this. So it's possible to work around that. And then this slide kind of relates to what we were just talking about. So if you own property inside of an entity, remember you don't own the real estate, the entity does. You really want to talk to your advisors, or if you want to bounce ideas off of us, well in advance, so that if your exit strategy is to sell, break up, go different directions, and each person doing a 1031 exchange, we may have to work with your advisors to make changes to the ownership structure.
Yeah. So for example, me and Bill kind of worked on my tenant in common for about like over a year almost, from the inception of the concept to, we actually executed. I remember I was in Hawaii, and then he's giving me a call, going through the exact strategy that we're going to do, and down to planning for the portion that's going to go for construction, and the portion, because as he mentioned before, within 6 months we can execute all our stuff. So in tenant income, we have a little bit more flexibility to essentially assign 100% of our proceed to the property, and have our partners, the tenant in common partners, bring in the improvement funds, etc. So very complicated, detailed, but it allows us to kind of successfully pulling that off on multiple deals. Yeah.
Absolutely. Yep.
Great. So other question, because a lot of people ask me this question, because we just had a session with Yona Weiss from the cost segregation, the medicine spec, cost segregation stuff. Fascinating stuff, because that's another way to get, reduced tax rate, essentially offsetting some of the active income if you're a real estate professional. So if you're a real estate professional, this could work for you. But then the follow-up question over there is like, how does 1031 exchange plays with cost segregation? I think the answer Yona had was cost segregation you can still do them, right? But what's gonna actually happen when you did cost segregation and you took the bonus depreciation, that's not gonna offset basis. So can you kind of explain then when I did a property, and it's actually a real problem for me, is I did a 1031 exchange, and due to my partner needs, we did a cost segregation on the property, and everybody got allocated a pretty generous K1, negative K1 in this case. And because I have good CPA, he kind of brought it up. He's like, oh, you can't really use them or whatnot, but want to kind of help demystify some of that, how they work together or how they kind of exclude each other.
Sure. And historically, they don't work really well together, but they can certainly be used together. And that probably made no sense, but
not really.
So the issue is, at least from a 1031 exchange perspective, before the Tax Reform Act, it didn't really matter, because you take a property, you buy it, and then you do a cost segregation analysis. And what that means is you're taking part of the property and carving it out as different asset classes that you can depreciate over 5, 7, 10, or 15 years. And you can depreciate that faster, you get a faster tax write-off, and it creates some liquidity for you. So it makes perfect sense. But you're also taking what you bought as real estate and carving some of that and saying, this is now personal property, it's not real property. And then you hold it for a period of time, you go to sell it and do a 1031 exchange. Well, the part you carved out is no longer considered a real estate. So when you 1031 exchange back then, we used to do 2 exchanges, or you could do them all in one exchange, but you'd classify some as real estate and some as personal property. And then when you bought your replacement property, you have to do another cost segregation analysis, split it out. And we have to make sure that you're trading equal or up in value for real estate, and you're also trading equal or up for every single little personal property category. And so it was problematic, but it could work. The Tax Reform Act now eliminated personal property in the 1031 exchanges. So now if you own property, you do a cost segregation analysis, you're carving part of the property out as personal property. Well, that no longer qualifies at all for 1031 exchange treatment. So the first issue is when you're selling real estate that you've done a cost segregation analysis on, you're not just selling real estate, you're also selling personal property, because you've chosen to carve that out as personal property. So that's probably going to be depreciation recapture of some type and will be taxable even in a 1031 exchange. However, on the buy side, you're going to be buying personal property. You do another cost segregation analysis. And with Section 179 write-offs and bonus depreciation and things like that, it may not be a bad thing. It may actually offset each other. So you can have some gain and some write-offs. And so you just have to do an analysis up front, have your tax advisor kind of crunch the numbers and see where it lands. If you're reinvesting, it's probably not a big deal. If you're selling and cashing out and you're not going to reinvest or buy anything, it's probably going to be a little painful with the tax consequence.
Got it. So then in this case, by just simply doing cost segregation, does that already disqualify? Or is the fact that we're taking bonus depreciation, getting the K1, but the fact that we're actually taking that K1, that tax credit, that will make it essentially not qualify? Because as partners, we may all decide to do cost segregation because everybody's tax situation is different. So majority will benefit from the cost segregation. But we also want to maintain, like we at 1031 exchanged into it, want to maintain this amount of money and continue to kind of transfer and grow the snowball essentially. So
absolutely. So I think there's an analysis up front, and there's also a guesstimate at the back end as to what your exit strategy will be. So up front, if you're taking like bonus depreciation or something like that, it might be that you're writing off a chunk of the real estate.
Yeah.
in which case it's still considered real estate. So that won't really help or hurt the 1031 exchange,
Mm.
except your cost base has been written down.
Okay.
If it's cost segregation and you're counting or carving it out as personal property, then it creates an issue when you sell it, even through a 1031 exchange that's not considered real estate.
Mm.
There's those who argue that it still is real estate too. So it depends on your tax advisor's point of view. In our point of view, you've done a cost seg analysis. You've chosen to carve that out as personal property. And so you can't say it's personal property now, and then later when you go to sell it, oh, just kidding, it's actually real estate. So I
Okay.
think you can't do both ways. Otherwise, under audit, I think the
Uh,
IRS comes in and goes, you chose to call it personal property for depreciation benefits,
mm,
and now you're choosing to call it real estate because of a 1031 benefit. I think they would go, you can't have both.
gotcha.
Um, but if you plan your exit strategy and you've got enough acquisitions of personal property, then all the bonus depreciation, 179s, and et cetera, might offset that. So you kind of have to just crunch the numbers and see what the outcome might be and then plan for it.
Okay. So then, and then you mentioned that the personal part, it would be kind of like the equal kind of investment, such as like the stuff that we talked about before, the less conventional stuff. And then in terms of the investment property, which is what our 1031 exchange was subject to, then it's okay to, essentially, we wouldn't be taking that bonus depreciation, and we would just, it's almost like we just spent money doing cost segregation, but didn't do anything with it.
Right.
Right.
Yep.
Okay.
Exactly.
Cool. But our partners still may benefit from it. It just, we wouldn't benefit from it when we exiting. Great. Okay. So that's good to know, because you just, oh, I just had a cold sweat moment over there for a second. Yes. And this is why, I always love you to have on the show, or listening to your sessions, because we kind of get into these very detailed discussions. And I'm always the one that kind of flag bills down any sessions and talk with him for like another 30 minutes or so. Okay, so one last question I have here is, how can I decrease capital gain instead of just deferring them? So people are kind of looking at opportunity zone, and then wonder if you can kind of talk about it. And my understanding, opportunity zone is a Congress bill that's, the bill itself didn't have lifetime over the 7 years. So some of the benefits that you would benefit at 7-year mark and 10-year mark may not be there. That to said, it can be extended. So really kind of focus on the 5-year benefit of opportunity zone. But a person just asked this blanket question about, how do you actually just, instead of defer it, just kind of offset the whole thing? Like, is there any way to do it?
It's tough. There's always possibilities to plan for other losses that might offset it. If you have losses in the stock market, other real estate losses, and you can sell those and recognize the loss and then recognize the gain in the same tax year, something like that.
And
So
on long-term holding, right? Only the long-term holding stocks instead of
that's
the
right.
short.
Yep. Long term, not short term. So those are possibilities. You can look at something like maybe a charitable trust. I'm not a huge fan of charitable trusts, but there are some scenarios where they make a lot of sense. So it depends on the person. Usually those are if you're older, 70s, 80s, 90s, and because you're going to lose control of some of your assets in the trust. But there's some huge write-off benefits, and when you sell, you don't get killed with the capital gain tax. So if you're older, then the charitable trust might make sense. The opportunities zone, the qualified opportunity zone does not work with a 1031 exchange. A lot of people will call and they'll say, well, I'm in the middle of the 1031 exchange with you, and I've decided I want to buy a qualified opportunity zone as a replacement property. And you can't. With a qualified opportunity zone fund, it has to be set up as a fund. Usually they're set up as an LLC with multiple investors buying into it. So that means you're a partner in a partnership. So the purchase of a partnership interest is not considered real estate. It won't qualify as like-kind property. So there's no way to get into a qualified opportunity zone. You could certainly buy property in a qualified opportunity zone, but it wouldn't be a fund. Therefore, it wouldn't get the benefits of the tax code. But what it does do potentially is you get a failed exchange. So you can't identify or you can't acquire property. Your exchange failed, it's taxable. You could take the amount of your taxable gain and go invest that in a qualified opportunity zone fund within that 180-day window. And at least, even though you have a failed exchange, you can defer the gain for another, say, 6 years or so. You don't get the full benefit, as you pointed out, because we only have about 6 years, not even 6 years, I think. I think it's getting shorter now.
Yeah.
But you needed to hold it for a full 10 years and you needed a 7-year window to get the full benefit. And now we don't have that.
Mhm.
But initially, if you bought it day one, what would happen is you hold it for 5 years, you get 10% of your gain is essentially wiped out. If you hold it for another couple years to 7-year mark, another 5% is wiped out. So 15% of your taxable gain disappears. But at the 10-year mark, all of that gain minus
Mhm.
the 15% was taxable. So
Right.
85% of your taxable gain is recognized and you pay tax.
Mhm.
Sorry, that was at the 7-year mark.
Yeah.
So at that point, you got to pay tax at the 7-year mark, but you probably haven't gotten your proceeds back yet because you have to hold the investment for 10 years
Mhm.
in order to get the tax-free status. So if it's
Right.
a really good replacement asset, you can get tax-free status. That's phenomenal.
Right.
But your current gain is only deferred for about 6 years, and then you pay tax on 85% of it.
Yeah. And we actually bought a property in the opportunity zone, even though it's an A location property, because every city has to allocate one of these. Very interesting. We definitely will have some follow-up questions for you,
Yeah,
privately over there. But we did do a tenant in common on that as well. So he'll be coming back at some point.
perfect.
We didn't intend it to buy that. Like a lot of opportunity zones are in kind of the low income area, so they may not make it into a good investment to get into. So I would encourage people not to use just opportunities, like never invest with just tax scan. Is my philosophy of investing. Like they have to make investment sense before that.
Right.
Um,
Yep.
yeah, so that's good. And this one might be a little easier to answer. It's essentially someone's asking, what's the first steps you would suggest for someone new to the idea of 1031, other than attending our webinar? Uh, yeah, and any of Bill hosted webinar. Yeah.
That's a really good question because most people don't do this, but you always need to have a team. And so my personal preference and personal advice would be you always have your team in advance before you even get into real estate. Have your real estate attorney, your tax attorney, your accountant, your escrow, your title, your realtor, et cetera. Have everybody lined up so you know exactly who you're going to be using, because you never know when you're going to need them. Even the attorney, you never know where all of a sudden you need quick advice or you've got a problem, what have you. So you need them all ready to go. So I don't know if this investor has gotten into real estate yet, or they've got real estate and they're now getting ready to do a 1031 exchange. So it's the same thing.
Mhm.
If you're getting into real estate, get all your advisors together. If you've got your real estate now, you're looking to sell maybe your first asset and do a 1031 exchange,
Mhm.
talk to your advisors. So the first step is talk to your tax advisor so you know exactly what your tax consequence is.
Mhm.
I mean, every now and then we'll see someone who turns out that they have a loss on the property and they
Mhm.
didn't know it, and they
Yeah.
sold, did a 1031 exchange. Well, if you do a 1031 exchange, you have to defer the tax consequence. So even if it's a loss, you have to defer the loss. In most cases, you want to recognize the loss so you can take
Right.
advantage of it. So always sit down with your accountant first, find out what the tax consequences are, and then meet with your whole team just to make sure you're keeping yourself out of trouble. Most people
Mhm.
don't do that, but I highly recommend it.
Mhm. Mhm. Like for example, I have, built like when we did a tenant in common, I even have settlement statements reviewed by my CPA. Like I thought he wouldn't find anything new. I was like, hey, after I use Bill for the exchange, right? Like what could it go wrong? But he actually has spotted on one particular transaction. This has to do with escrow, how they actually pay the account. And then he spotted to said, hey, because you're actually taking out your rents, essentially you're actually taking out the deposit essentially as a proceed, versus like getting that transacted during the closing versus bring the cash to the table. The deposit is not really your money, so now it's counted as proceed, then you potentially will have to pay tax on that part. And I was like, oh, I don't want to do that, I didn't know. So then he's like, well, you just have to bring a check to the closing versus having that all uh, wrapped up in the closing cost, right?
Absolutely.
So
Yep.
that was like, I was like, oh, interesting. And and then I checked it with Bill and and your service and stuff. You're like, yeah, actually this is what we should be doing. But obviously that's outside your facilitator's area, is kind of having your CPA also take a look at them as well.
And that's a perfect example of, 2, 3, 4 days before closing, get a copy of your estimated settlement statement, go to your CPA and run all the numbers past them and see what they can identify that might be an issue.
Definitely. And then so Great, awesome. I think these are all the questions we have. I know, like we asked a lot of very in-depth question, and I'm very interested in all the other like kind properties because it just kind of opened up a lot of more horizons for viewers over here. Because oftentimes we're strapped with this 1031 exchange, essentially this slide over here that you talked about. The 45 days to identify it, 180 days to close, it's not really an issue, but the 45 days to identify, like calendar day, not including, like this is including weekends as well, like where everybody else is not working. This makes 1031 exchange a lot more difficult to do. So that's why the subsequent question was like, what other alternatives that I can use to essentially do that? Can you kind of talk about, like quickly, I know we have to wrap it up over here, like a Delaware trust, because that's often a one that kind of people talk about in terms of exchanging into.
So actually the company that brought it to the market was Inland Capital and Inland Securities out of Chicago, or out of Illinois. And what it is really a trust drafted under Illinois, or under Delaware law. And the trust itself will actually acquire real estate, put it together, package it, get the financing in place, and then the investors, all they have to do is identify a percentage of the trust. They become a beneficiary of the trust. So in most cases, they're buying less than a 1% interest. So you identify like a 0.5% beneficial interest in Delaware statutory trust named blah, 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 including the following properties. So the IRS has actually issued a ruling on that specific trust where it does count as real estate. So buying that is considered purchase of real estate for tax purposes. And because you're buying a percentage interest, you can buy exactly what you need. So if you, one way people use that is they're doing a 1031 exchange. They've sold like $1 million property. Maybe they buy an $800,000 property. They have 200 left over. It's difficult to do anything large with 200,000. So maybe you go buy $200,000 worth of a Delaware statutory trust. And with leverage, you're probably getting about a $400,000 asset, and you've satisfied your exchange requirements. The other beauty is the Delaware Statutory Trust does not, they put the packaged financing together, so the investor doesn't have to qualify for it. So for investors who have no earned income, self-employed, they don't have a long track record, they're retired, whatever, they don't have to qualify for the DST. They just go in and they buy a percentage and they automatically are approved. They just have to be an accredited investor to qualify, which means you have a net worth of $1 million or more, excluding your home.
Gotcha. That's very interesting. I definitely will have some more follow-up question for you because I'm on the other side of apartment syndication. The question I always get is, can I 1031 into a syndication? The answer in general is no, because it is a company share that you essentially are purchasing. But we are using cost segregation, et cetera, to kind of mitigate some of the tax issues over there. But that also requires people to kind of actually be a real estate professional to take best advantage of it, essentially. But on exit and on rebuying a new property, cost segregation could kind of work out pretty well for real estate professionals, whatnot. Yeah. So awesome. Well, thank you so much, Bill, for your time. I know it's way beyond our time, but definitely, this is definitely eye-opening. Every time I talk to you more, there's more bubbles, like just shows it in my head on like, oh, this is how we could have structured these things. So Bill, what's the best way that people can kind of contact you and your exchange company? I understand that you kind of also doing some other business with deferring taxes, right?
We do. Let me see if I can get to the last slide here. It's got our contact information.
Perfect.
So yeah, so you can call us at the headquarters in San Diego, which is 619.
Are you sharing your screen right now?
It looks like it turned off. Let me try that again.
And then, by the way, is it a presentation that we could potentially share with people who viewed us? But at least the contact sheet we can kind of share with them. Yeah.
Sure, I'd be happy to. Absolutely. Okay, let's see if I can do this again. And is my screen showing now, or?
No, not right now.
Let's see. There we go. And there we go. How about now?
Great. Yes.
Perfect. Success. So the number there is the 619-239-3091. That's the general headquarters number in San Diego. So they can get me through that number there. All of our contact and various offices and whatever are listed in the website, exeter1031.com. And our trust company is actually located in Cheyenne, Wyoming. So you can get a hold of them at the 307-222-8750. And Exeter Trust serves as trustee for all the qualified trust accounts for 1031 exchanges, but they also handle self-directed IRAs where the client wants to invest in real estate through the IRA. They do custody accounts, specialized holding escrows, and title holding trusts or land trusts.
Mm-hmm. That's awesome. Well, thank you so much, Bill, for this.
My pleasure, absolutely.
And the section is recorded, and it's brought you by EasyFI University. Check us out. The recording will be on our website once for tomorrow. Yeah. Thank you.
Bye. Take care.
Bye. You too.